In the final Nexgen video, we're going to discuss management, both entries and exit management for your trades. It's very important that you take the time to learn the Trading from the Edges video, the Trend Trade video, which has the rules, and the volume analysis for the market flow in order for this video to be most effective. Again, we're going to warn you. Our expectations for you is to make at least $400 a contract on one big S&P contract or crude oil contract or gold in a day. This is going to be a minimum expectation. We're going to teach you really how you're going to be able to meet and exceed those expectations. So let's talk about entry and management basics. The very first one I'm going to discuss is buy low, sell high. Conventional age-old wisdom, right? It's really very important that when you're entering a trade, going long, you're buying a well-defined support and you're buying as close to that support as possible. That's going to enable us to buy low. It's also going to enable you to sell high when you're entering a short position from a well-defined resistance area. One of the most important things that not only the entry but the exit is going to be reversed. So if you're buying low, you're selling high, or if you're selling high to enter, you're going to be buying low to exit. Only enter at key areas or after a market flow confirmation from an area. Getting a great entry is going to make your management considerably easier. A quick no jumping in because you think you will miss it, quote unquote. This is one of the biggest downfalls for most new users of our software. They just jump into trades and they're not thinking about the entry area, where they're going to be placing their orders. Once you get into a trade using a limit order, you're going to be exiting with limit orders for your profit targets, both first and second profit targets. We're going to make sure that you use an ATM strategy, and you're going to put your stop where the market shouldn't go first, but generally that's about 12 ticks, 3 points on the S&P, 10 to 12 ticks on crude oil. Never trade without a stop or a target in place. Now let's look at the trading screen. Many new traders open up this screen and they start punching buttons. Buy market, sell market. They want to know what all these buttons are. Almost never, and when I say never, I mean never, are you even going to use this. You're going to open up this screen. You're going to set your ATM strategy for your contracts and stops and targets that you want to trade. And then almost without question, you're going to click this button and get rid of this screen. In the rare case you've made a mistake or you need to get out immediately, you can use the close button. But as far as the rest of these buttons, you're almost never going to use them when you're trading our software properly. Now, while you have this up, and again, before we close this, I'll just show you. To generate a buy or sell, either one, you're going to just right click with your mouse on the screen and then you're going to hit buy limit at whatever the price is. You're going to do the same if you're selling. If you put your mouse up here and you right click and hit sell limit at, but that's really what we want to do to get our orders in the market initially. Now once you've placed a market order and it's sitting there waiting to be filled, for example, if you were doing a pivot stop out long here, you'd have a limit order waiting. And once you have a limit order waiting, you can mouse click on that line and then you can hold the mouse down and drag your stops or targets or entry areas up and down, all the orders anyway. And you'll be able to see where it's going to be placed, and then when you let go of your mouse, it's going to move the order. So a lot of our traders will actually place a limit order down here initially just so it's out of the way, and then they'll move it up into the correct spot when they're ready to actually make a trade. We're going to start off initially with mostly trend trade thoughts. I mean, all the trades kind of run together. You're doing the right trade at the right spot for the right reasons. When you do trend trades, we talk about it, and I'm not going to go through the rules here, but Again, making sure that all of your charts are correct. This is a big one that a lot of new users don't use. They hit a termination spot and then they still do trades. So again, know when to quit, and you can watch the other videos for that. And then really ultimately this is where we're spending our time when you're trading during the day. You're defining and placing an entry, a limit order entry at the spot you want to trade. And we want to do it at some type of support, mid bands, 1-to-1s, some type of line that gives us an advantage. So when you're looking at the market, the idea is that we're going to buy low. So what we need to do is we need to place a limit order to buy just above the support that we have as our trading rules. So if we were selling resistance, we'd place a limit order at a sell spot. If we're buying support, we're placing a limit order here. And the idea is that we're getting filled on the way down as it reaches the support, and then hopefully the market turns. And when you get comfortable with the trading rules and the plan, this is going to become very easy for you. You're going to get in at the right spot. You're also going to use the same click and drag method for your stop orders. So your initial stop may start out down here at 3 points away, but eventually you're going to click on that and you're going to move your stop below a new pivot as it goes up. Same thing on the sell side. And again, we're not going to get too deep into rules here, but once you got a top in place and you've got a great spot for a sell, just put a limit order in there and close your eyes and grit your teeth and hope it wins. I'm joking a little bit, but that's really all you have. So the most important thing is what condition happened before and where's your trade going to be and where are you going. Once you have all that down, trading's not going to be too difficult for you. Another, and again, I'm kind of bringing in more charts here, but I want you to see the thought process. If you have a top in place and your triggers are going down and you want to sell, you have to sell on the high. And again, it's still not a guarantee of a win, but what it does, if it does actually go down from resistance to support, it will maximize your position. If you were to enter the market down here, let's say, this is a very common one for new traders. They'll get in or they'll recognize a trade late and they'll jump in down here. And what will happen is they end up with a very uncontrollable position. So if it does make divergence or a little pivot stop out, they're actually losing all of their money instead of actually entering a position. Making sure that you're buying or selling on the way up or down is going to be very important. And it's going to feel a little scary to you at first, so you're going to have to get used to the concept of selling high or buying low. And when you look at it, you look at our charts and we go through rules, you've seen this picture before, I'm sure. The edge of fibs with the right condition, followed by triggers rolling up, and the market flow also supports it. And the idea is that we're able to use our Fibonacci and our trigger lines to define where these little areas are so we can get ourselves into a position as it comes down. So as the market starts to go up, we're able to maximize the profit on a position. Another rule of thumb for you, if you're doing a trend trade short on your 5-1 chart and you're using your market flow to assist you, and a lot of times these high volume lines are really great for defining trend trade areas. The idea in this slide is to make sure that you give up a couple of ticks and you're getting in just before the line and you're not trying to be the line. Because if the market reaches the line or just barely makes it, in order to get filled on a limit order, the price technically has to go through the limit order price or else you're not guaranteed a fill. Once price goes through your limit order, you're guaranteed a fill, and then if the conditions warrant, the market will continue in a favorable direction for us. And you're going to see this, we covered this in our market flow video, but it's always nice to see the same thing over and over again. Again, if you have a great bottom and you're going to be using these green high volume lines as entry areas, especially with the fib, the idea is to get in a tick or two above it so you can actually make some money. And then if you need to buy it again, same thought process. Giving up a couple of ticks so you guarantee yourself a fill and not try to get that exact last tick. Now, if you're selling from the top, again, not selling the top, selling after the trigger lines roll and the market flow agrees, getting in just before the area instead of trying to get in at the area is a very important concept, giving up a couple of ticks. Now we'll focus a little bit of our attention on edge trading. And again, I think trend trading is probably easier for most people because everything's going your way. When you guys look at trading the edges, we talk a lot about a pivot stop out. And when we talk about a pivot stop out, sometimes they happen and then sometimes they could potentially happen. And if we're going to buy the bottom at the edge of fibs because our large chart says it's an okay thing to do, then what we're looking to do is, again, just really simple. Wherever the prior low was with divergence, we're placing a limit order there in the hopes that we reach our Fibonacci support, guaranteeing us a fill as they stop out the prior low and then reverse, which hasn't happened yet, but this is the setup to the trade. So when we have a double, we're basically buying a double bottom here. And the idea is that you're going to place your limit order at the prior low, so when we do make that bottom, you'll get a fill. Same thing if you were selling on the way up. Again, whether you sell right at the magenta line or maybe split the difference between a fib and the magenta line, somewhere inside of this window, we're anticipating the market to go up to resistance and then getting filled or getting short on the way up so we can sell high and then buy it back later at a lower price. I want to interject a thought or introduce a thought. I say introduce. This was a entry technique that we used 10 or 12 years ago. But again, it's maybe a good time for some of you to think about other ways that you might get into the market, because selling at the magenta line, which is the rule, sometimes is very scary for a lot of people. So we used to teach a stop-in method. And what that means is very simple. We get the conditions true for a sell signal, meaning a pivot stop out, but instead of going in on the way up, we're actually giving up a little bit of the potential for some confirmation. And the idea is here that we're going to place a sell stop order. So we'd right click. So when the market's up here, you're going to right click on your chart right here, and you're going to say sell stop at whatever the price is, 86.50 or 35.86.50. So that way, if it goes above the pink line and then it's coming back down, you're getting filled on the way back down and putting your stop above the high pivot. Now, obviously, if you would have sold the pink line, the magenta line, you would have made more. But if it keeps going and never turns around, sometimes this little bit of confirmation is worth it for some of our traders. And many of our traders who've used this method for 15 years plus. And again, certain situations call for different types of entries. Sometimes you can get in right at the edge knowing it's really good. Sometimes you might want to wait for a little bit of confirmation. Now, another way we'll do confirmation, and again, management. So let's assume you were in some type of a trade long. And for whatever reason, the divergences get you out of your position, right? That is one of our termination conditions. If we get 3 divergences from relatively the same area, we're going to get out of any long trades we're in, but that doesn't mean the market won't go up. It just means it's probably going to go in somewhere from the edges. Now, just like before, we have 2 choices, right? We can try to buy a pivot stop out, or we could try to buy at the edge, but some of you would like to have a little more confirmation. So again, the market flow signal, an antenna bar, yellow paint bar, white paint bar, an arrow up, some type of signal can get you into this position. And this is more of what we call a confirmed market flow confirmation. Instead of just getting in and hoping, we're allowing the market to generate something bullish so we can get in and we can put our stop a couple ticks below the low. So it kind of gives you a concrete, again, not a guarantee of a winner, but if it keeps going down without a signal, you're guaranteed to miss a loser. So again, you're going to have to spend different time with these different techniques and figure out which one is going to work for you. Another example of the stop order to use as an entry. And again, I've showed you what the order looks like more in this one. So let's assume that the large chart looks pretty good and we should have a bottom. Okay. Now, the small chart wasn't quite right, but the market went up anyway and is coming back to retest our fib support. Now, using our market flow, we can see we had a couple buy signals off of the edge, and then the market's coming back down into the fibs, the high volume line. Maybe the next bar up will be a buy signal. So if it actually happens, we'll end up with a second divergence from a fib, which is one of our termination conditions anyway, right? So the idea is that we're anticipating this area to hold, and if we get a signal, we're going to go long, but we're going to give up a few ticks just in case it doesn't. Now, this trade, when it works, and this is the same spot, but after the fact, right? So before the fact, it looks like this. And again, you're never going to know what it's going to look like after the fact. The idea is that you're reading your fibs and triggers and knowing your areas correctly. So this is what it looks like after the fact, and you can see the amount of money generated on this was, easy 7 or 8 points on the S&P, getting up to fibs, may not even stop. So again, that's an alternative entry where you're stopping yourself in. And then, never, let's just say you recognized it, but you're late or you were out or you're getting coffee. Sometimes when the trigger lines roll, you can take a second chance at it, especially if the market flow agrees right here. Maybe a high volume line or something else into this area. Again, this little technique right here should only be used with triggers at a mid-band generally, or mid-band and fib, and only after we're going up for sure and you know it. So again, there's a lot of precursor into being able to use a pivot to stop your, or a pivot stop in, or a stop order to get yourself into a position. And again, going back to the slide, it looked like this. So 88.75 is where we were trying to buy, and if it went down even a tick or two further, you could tighten that up just a little more. And then this is the after effect. And again, reading your fibs, divergences, and triggers, this area should hold anyway. And this is more of a, ooh, I missed my trade, but I want to catch it anyway. So just a couple different techniques for you to think about when you're looking at your charts. Now, this is another slide you've seen in the market flow video, but again, this is how you can use the market flow at the edges with weak triggers that should hold, and when we get some type of antenna bar or signal, stranded buyers, you're getting in after the bar. And you've seen this picture before as well when we talk about the market flow strategy. Not a great bottom is important. Then getting to the edge of resistance, and then getting a signal, and then getting in after the signal. It's okay to get in after the signal. You don't have to get in before the signal when you're trading from the edges. Now, sometimes if you have a perfect edge in your 21-3 charts or everything on the planet agrees and you have a high volume line there, you may choose to put a limit order just short of the edge and get in on the way up. Again, it has its benefits, because if it goes down or hits there and goes down very quickly, you're not scrambling for an entry. And, this one actually did go down. And you can see once we actually make a pivot or you make a down bar, you could still get in. And again, if it goes all the way to the target, it's not a big deal. Again, jumping in front of a moving train up takes a lot of experience and a lot of confidence. And again, high volume areas are going to help you at those areas when you're being specific. Now, let's just say you missed the pivot stop out of the long, right? You recognize the bottom and you meant to go long here, but you missed it. Again, I just wanted to show you another example of that second chance entry. At the triggers, at a mid-band, with everything going up and everything agrees we should be going up. Sometimes you get the second chance. Now, this is also where some of our traders who went long here may actually add on to their position. And again, you notice everything is with a limit order at a spot. That's really the way we do most of our trading. Now, let's say, you're looking for a short and you're recognizing, like from the market flow video, that we might go a little bit higher. Instead of just getting in at the 5-1 chart, you may say, hey, I might wait till it gets to the magenta line or I get a signal, just in case, the 1-to-1s make it go up a lot higher. And, as we progress forward through this, you can see the market did go higher. And if you sold over here at 03, you're really running up close to the edge of your stop already in the position. If you waited for the high volume line with a white paint bar up and both triggers down, you're already in. So again, this is a really good spot where you could have gotten in recognizing the white paint bar into the area. Now, the benefit of a white paint bar into a high volume line when you're trying to go short is that if it generates a signal, you can still get in. So again, you get two choices here. You get an early entry, which I didn't show you here because of the white paint bar up and the triggers going down into a high volume line, or waiting until the signal happens and then getting in afterwards. As long as the market continues down to its target, it's not really going to make that much of a difference. Again, in the first scenario, you're only risking a point. In the second scenario, you're risking 2.5 points. So technically, your risk is up by 150%, even after the signal. So you can see it exponentially increases your risk, but sometimes you need that confirmation. Sometimes you're going to find yourself in a trend trade that looks like this. And I put this one in here because it happens a lot. Where it's, you get this trend trade spot and then new users will get stopped out and then it goes down and they're like, gosh darn it. Now, this is a function of recognizing two things. Not only do you have a trend trade spot and a look and a high volume line to support it, but just above it, you have an edge on all of your charts that should hold as well. You have two choices. Number one, wait for a market flow signal and then get in, and then you're not in early. Or number two, get in and have a little larger stop so you don't get stopped out. Again, in this stop scenario, I had to risk 4 points instead of 3 points. Again, this is, kind of shooter's choice in there. And again, you just have to recognize when you get into a situation that you don't want to get stopped out with a 3-point stop because of bad bottom, great top, don't get stopped out, or if you do, use the market flow to get you back in again after another signal, which we talked about in the market flow video. Now, we're going to assume a very strong large chart up. And, you get divergence from a fib and you're like, oh, no more longs. But the large charts say we're going up. Well, as we get down to the mid bands and we retest the fibs in the mid bands, again, this is more of a 8-2 small trigger, but it's a little bit different configuration. You guys will have a template for this. But as the triggers roll back up, you're able to take a second chance entry. And a lot of our traders will use this logic when they still want to go long because of all their large charts and they're just waiting for divergence or the area to hold and the triggers to agree, and they're placing a limit order just above that mid band as a second chance to get the rest of the long move. You'll be able to also use this logic at the edges. We've used this for a long time. I'll show you a couple pictures, but the idea is quite simple. If we get to an area that's supposed to hold maybe, triple strong termination spot on every chart, you can be a little bit more assertive at the edges when the triggers are rolling up to help you out. Now, one word of caution, if you do get filled, you have to be somewhat cautious about trailing your stops up too quickly or they're going to get you. Because a lot of times they love to retest the fibs in one-to-one areas especially. So make sure that you're allowing the market to retest the fib and then start back up before you actually trail your stops. Again, just recognizing the strength of the small triggers and where they stay relative to your fibs when it retests, give you this is another instance where maybe you could stop yourself into a position. Again, you'll get to see this kind of look a lot. Now, one of the other uses of waiting, which is always a good thing, which we've talked about this a million times. But if we want to sell the edge of Fibonacci resistance, but the triggers are just too strong, wait. Just wait. If the fibs don't break and then you get a couple divergences, and especially if you get a couple divergences, and then the triggers finally roll back over, now you've got some type of trigger at the edge that's more advantageous, and you'll find that you'll have a much easier time selling Fibonacci resistance after the triggers roll over, after they weaken, after they get back below, and then you'll have a much easier time. A lot of traders make a mistake over here, jumping in, getting run over, only to watch it go down to their targets eventually. So again, if you have to slow things down, wait for the triggers to suggest it's okay, and then, again, look, pretty easy. I placed a limit order at the edge of fibs. And then it got filled, and then I waited until a down bar, and obviously I could have trailed my stop a little more, but it was going our way. Again, we've been using this logic since 2004, 2005. I mean, this was our plan from back then. I know it looks antiquated, but look, fibs, divergence, wait for the triggers to roll, sell a pullback to the trigger lines. We've used this logic forever. You'll see it over and over and over. You'll recognize it when you're supposed to use it on your charts. Let's talk a little bit more about the management side of things. Again, basics for management. Only follow rules that you have tested in your own plan using replay history, study of history that is, and the simulator for your trade management. Don't just jump in or jump out because you think something may happen, right? Fear. Everything that you do has to be rules-based, based on the indicator looks and patterns in the market that you have tested out if you're going to be successful. Remember, strong triggers on your chart suggest larger targets are appropriate. If the triggers are weak, be quicker to take your profits. Believe there's always another trade coming. If the indicators change, you're going to have to get out of your trade. Be prepared to reduce your stop risk after pivots and further risk reduction when you have divergence or the conditions change on your indicators. Look, the number one rule in trading, don't lose all your money, right? So do this on simulator and test these entry and stop techniques out so you're comfortable with them as you start trading the market. And remember, taking 200 or more is half of your daily minimum goal. So once you reach at least $200 in profit, never lose money on a trade. And I say that because I've seen 150,000 traders get up $200 or $300 and they actually give away all their money and end up losing. There's so many trades that happen with our software, just don't lose money. So let's talk about stop placement. The initial trade is going to look something like this, right? Where you're going short as the market's going up and you're getting short right here. And your original stop is going to be much higher, right? Like 3 points away. And then after the market makes down bars, then you can move your stop behind the high pivot in place, right? Bars were going up, now they're going down. You can put your stop above the high pivot. Only after the market turns can you move your stop. If you do it too early, they're going to get you and then they're going to turn. So you are willing to risk this much money to start off with. Don't touch anything until the market actually does what it's supposed to do. Now, if you get into a position and the market starts going up and then makes a little retracement and then goes up again, you can go from your original stop to your first move stop behind a pivot. And if you make a higher pivot, you can put a new stop in. And if you're still in a position and the market goes up and makes a new pivot, you can put a stop behind the new pivot. And again, sometimes this is the technique that gets used when it's a very strong trending market. We've got strong triggers, strong trend, we've got everything going. We want to hang in for bigger profits if we get them. So this is how we're going to do it. Trailing stops only after the market makes new lows, reversal bars, and then starts going up again. It'll make you stay patient in your trade. You've seen this picture 72 times now, right? Don't get married to your position because the large chart is strong. Sometimes the small chart will tell you when to get out. Again, if you get a second divergence, you really are going to have to evaluate whether you want to do another trade or not. So if you went long and took 4 points and then got out with the second divergence, you can always buy at a support if you get another opportunity. Again, if you do and you get a red background or the triggers roll over and a pivot stop out, you have to know when to quit your trade. We talk about this a lot in the other videos, so we shouldn't have to do it much here. Again, this is an absolute. If you're short and your conditions change, like your triggers both roll up and you have bullish divergence, get out of your position. Don't lose money. Again, this one's in the trend trade video and the trading plan and everything else, but again, recognize when it's okay to continue going short as long as the triggers are going down, and then when the conditions change, stop, because the market will generally retest a better area so you can get in from an edge or maybe have a full trend reversal. Now, we talked about in the market flow video seeing the same thing. You're going to get the easy short trades. They're obvious. Then you're going to get a pivot stop out and you may decide to do another trade. You may not, but if you do, again, market flow, high volume areas, and long signals at the same time you get a green background with divergence means you better get out of your position. This is another one from the market flow video, but it's the same process. You might have gone short, but you have to get out of your position when the market flow and the divergence and the green background agree. I say that, but this is another benefit of market flow. Same condition, but you have to stay in. And you're saying, wait a minute, Novak, what are you talking about? Green background with divergence, I have to get out, right? No. Notice if we remember we got short after a signal down, this was that trade. Look what happened. There's no high volume lines. There's no triggers rolling. Everything is very bearish on the market flow, and we even have a pink high volume line helping us out for resistance. So if the market flow suggests that we should stay in, then you can stay in and look at the target. We're talking about 6+ points on this trade. Now, it's not the same over here. If you were short, the market flow is saying get out. So is the bullish divergence. So in a situation that the large chart's very strong, sometimes these will get the new traders out and then the experienced traders will stay in. I'm telling you that the market flow will give you a little bit of a heads up on if it's helping your position to stay short, right? And yes, it did go down, by the way. And you can see the market flow, short and then subsequent shorts, all confirmed by the market flow, and we indeed did make it down to a lower level. So again, just you'll be able to use the market flow as a guide for maybe holding on to a position a little bit longer. Now, momentum style trades. You guys are all in love with these, and that's great. I love them too. Keep in mind when you do some type of a momentum style breakout, and again, especially after a bottom or anything else, anything that's a high momentum trade, generally taking 4 or 5 points is a good thing. And then if it keeps going, great, but momentum trades have a tendency to die after divergence. And this is especially true when the prior trend was down very, very strong. That first long trade doesn't always follow through all the way. Sometimes it does, and if it does, we're in, and if it doesn't, we're watching out for it. So again, depending on the strength of the prior trend down, you may think about taking 200 or, give or take, and then trailing with divergence. Because on the first trade going the other way, if you get divergence or a couple divergences, it almost always gives you a second chance from a lower area, usually a pivot stop out. So you talk about the pivot stop out logic, where we're buying with a limit order at a prior low and 1-to-1s and fibs, and then we can get into the position, and this is the next slide. So you can see we got into the position with virtually no risk after an up bar, and then as it travels up with our red background, it's not just about getting out or staying in. This position right here is up 4 points plus. So it's okay to take half off at 4 points plus, and then make sure that if the conditions are changing on you, you're not going to lose money and your stop starts to get moved up a couple ticks behind the divergence, because if divergence happens, we'll probably go back down again. And this is especially important when the prior trend is really strong to the downside, because you get 1 or 2 attempts at a long trade, and then the conditions change, and then the prior trend will resume again. So you have to be very careful when you're first going the other way. Another thing that we talk about a lot in the other videos, but I'll reiterate it here, if you're trading a big edge from a big area and you're waiting on a market flow signal to do it, ignoring the market flow when the large chart says we're going up for a long way. Again, I talk about it being a harder thing to do in the beginning, but this is part of your management routine. When will you pay attention to the market flow and divergence? And when and why, based on larger chart conditions, are you going to ignore it? It's going to make a big difference in your profit. Again, another slide from one of our other videos, but again, the management in this scenario with large triggers going up is going to be much different than if you hit resistance and the triggers are inside of each other. So you must be much tighter to manage a position when the triggers get weak and inside of each other, a little more loose to hang in for more profit when the triggers are outside of each other. Again, keeping in mind termination spots. Not only are they great spots to take profit, so if you were long, recognizing that the triggers are inside of each other, you would take profit at the Fibonacci on the way up. Right? Buy low, sell high, meaning put a limit order just above below the resistance. And then if you recognize the right look, now you remember that trade that we talked about, the pivot stop out from the edge, whether you're getting in on the way up or maybe half a bar on the way down as it goes back down below the divergence, taking your first money because it's the first one going the other way, and then maybe getting another attempt, maybe after the trigger lines roll, for going short. All that happened at the very high. And then if it actually goes, then you get some easy 5-1 trend trades after that. So you're really going to increase your profit from the edges when you recognize these spots as well. If you are long and you get to an absolute edge, right, multiple fibs with 1-to-1s, take your money, even though the triggers are strong. And that's really why this slide is in here. It's a stop going long slide, but it's also a take your money slide. And if you were short, if you get to a prior low with divergence, take your money, take your money, take your money. If it breaks, you can always get back in again, but usually they don't, or they bounce quite a bit. And you'll start to get the rhythm down between, the not great lows and managing a position, right? If you were doing 5-1 shorts, and then taking trades from edges, and then managing positions, and then taking some great 5-1 trend trades, and then recognizing the 1-to-1s at fibs where you would take your money, and then potentially starting the process going the other way. So money management as well as entries and exits all live off of the same charts. So when you're finalizing things, right, the money's made or lost when you're entering and exiting. So you have to learn and concentrate on buying low and selling high so you have great entries and exits. These great entries and exits are going to exponentially increase your profit and decrease your risk. Do not get married to a position when the indicators tell you to get out. Also, conversely, right, stay in the position if it says you can get more. So again, this is a really important part of reading your fibs and triggers and understanding what should happen next. Make sure you're always using an area of support or resistance to get in or out. Take 200, plus or minus a bit depending on the market. And then reduce your risk so you don't lose. And then ultimately you're going to be able to take what the market gives you, but if you take some profit first and then get your stop up, it's always going to help. And like always, the most important thing you can do is annotate your charts, include a rationale for why you did the trades, and then post those pictures in class for feedback so we can tell you whether you're reading your software and using your software correctly so you can reach your goals and objectives. I appreciate your time. Thank you for listening.